We are witnessing the greatest disconnect in financial history. While the mainstream media tells you the economy is stabilizing and inflation is under control, the physical markets are screaming a completely different story. We have entered an era of the Great Divergence, where the digital representation of wealth is losing its grip on the physical reality of resources. Silver has just completed a monumental 50-year breakout, clearing a technical ceiling that has suppressed the price for over 5 decades. Simultaneously, oil is forming a structural technical pattern that hasn't been seen in over 25 years. We're not just talking about a simple price increase or a standard market cycle. We're talking about a total fundamental reset of the global monetary order as we know it. The era of cheap energy and undervalued precious metals is over. Today, we are diving deep into 3 specific advanced charts that prove why $500 silver and $369 oil are not just wild theories or sensationalist headlines. They are mathematically probable outcomes based on current supply deficits and decade-long technical consolidations. We will examine the collapse of the paper-to-physical ratio and explain why the COMEX is facing a delivery crisis that could trigger a vertical move in prices. If you have been waiting for a sign that the financial system is shifting beneath your feet, this is it. By the end of this video, you will understand the gravity of these setups and why the window to position yourself is closing faster than most realize. Prepare yourself, because these are the charts that will blow your mind and redefine your understanding of value in the 21st century. Look closely at this 53-year chart. What you're seeing is the most significant technical event in the history of precious metals. For over half a century, silver has been trapped in a giant sideways range, repeatedly hitting a ceiling at the $50 level. In the technical analysis world, we call this a cup and handle formation on a secular timescale. When a breakout occurs after 50 years of suppression, the resulting move is rarely a slow climb. It is usually a vertical explosion. We have just witnessed silver surge by over 250% in a single year. While the mainstream calls this a bubble, the advanced technicals suggest this is merely the first wave of a 3 drives up pattern. Following this massive move, we are seeing a healthy consolidation, but the floor has moved. We are no longer looking for support at $20. The new floor is established firmly at $50. This is what analysts refer to as price discovery. In a vacuum of supply, the price must move to a level where sellers are finally willing to part with their physical metal. But why is this happening now? The answer lies in the Shanghai premium. For the last several months, silver has been trading at a 13% premium in the East compared to the Western paper markets. This is a massive arbitrage opportunity that is physically draining the vaults of the West. If you can buy silver in London for $30 and sell it in Shanghai for $34, you do it until the London vaults are empty. And that is exactly what is happening. The physical metal is flowing east at an unstoppable rate. Right now, institutional investors and bullion banks are so desperate for physical metal that they are paying retail silver holders a 12% lease rate just to borrow their bars. Why would a bank pay you 12% interest to hold your silver? Because the physical inventory is gone. Major players like StoneX are reporting that the available for delivery categories in the warehouses are at record lows. The paper market, which trades over 100 ounces of digital silver for every 1 ounce of physical metal in existence, is finally breaking. When you adjust the 1980 high of $50 for the massive expansion of the fiat money supply we have seen over the last 4 decades, the numbers are staggering. To reach the same level of purchasing power today, silver would need to be priced at over $500 per ounce. We aren't predicting a miracle. We are predicting a return to historical mean valuation. The paper lies cannot last forever, and the physical shortage has now become terminal. If you thought the silver chart was explosive, wait until you see what is happening in the energy sector. This 21-year inverse head and shoulders pattern on the crude oil chart is quite literally the most bullish technical structure I have ever seen in my career. We are looking at a formation that has taken over 2 decades to build, stretching from the highs of 2008 through the generational low of the 2020 lockdowns. In the world of technical analysis, the longer the base, the higher the space. When we measure the depth of this massive pattern, the mathematical target is not $100 or even $200. It is $369 per barrel. To the average consumer, that sounds like an impossibility, but the physical reality on the ground is already paid for this move. We are not just looking at a chart. We are looking at the consequences of 10 years of chronic underinvestment in global energy production. According to the latest reports from the International Energy Agency, we are currently staring down an 8 million barrel per day supply deficit. This is the largest shortfall in recorded history. While governments have depleted their strategic petroleum reserves to keep prices artificially low, those reserves are now sitting at 40-year lows. There is no more safety net. We are entering a period where demand is inelastic, but the supply simply does not exist at current price levels. The geopolitical risk is the match that will light this fuse. Any disruption in the Strait of Hormuz, a bottleneck that handles roughly 21 million barrels of oil every single day, could send prices vertical overnight. Analysts have dubbed this the taco scenario, a total breakdown of the global supply chain. But even without a war, the physical market is already breaking. The physical price of Dubai crude is currently trading at a staggering $38 above the paper futures price. When the physical price deviates that far from the screen price, it tells you that the paper oil market is losing its ability to reflect reality. What most investors fail to realize is the inextricable link between oil and silver. Energy is the primary cost in mining. It takes a massive amount of diesel and electricity to move 1 ton of earth just to extract a few ounces of silver. As oil moves toward $369, the all-in sustaining cost for miners will skyrocket. This creates a feedback loop. High energy prices make silver more expensive to produce, which further chokes the supply of a metal that is already in a terminal deficit. We have just confirmed the breakout above the neckline of this 21-year pattern. This is the point of no return. As the world realizes that green energy cannot fill the gap left by hydrocarbons in the next 5 years, the scramble for remaining barrels will drive prices to levels that will fundamentally rewrite the global economy. The third chart that will absolutely blow your mind is the gold to silver ratio. This is the ultimate truth meter for the global monetary system. To understand where we are going, you have to understand where we have been. Historically, for over 2,000 years of human civilization, this ratio naturally sat at approximately 15 to 1. That was the geological reality of how these metals come out of the ground. However, during the era of unbacked paper currency, that ratio was artificially manipulated, pushing it as high as 100 to 1 or even 120 to 1. We are now entering a sovereign debt crisis of such magnitude that the world's central banks are forced to return to real assets. Gold is currently acting as the anchor for a new global monetary system. We are transitioning from what economists call Bretton Woods II, which was based on debt and treasury bonds, to Bretton Woods III, a system backed by physical commodities. This is not a conspiracy theory. It is a visible shift in central bank behavior. Look at the data from the last 24 months. Central banks across the East and the global South are accumulating between 50 and 60 tons of gold every single month. They are dumping paper debt and hoarding the only asset that has no counterparty risk. As gold climbs to our projected target of $5,000 per ounce, the silver market, which is much smaller and more illiquid, will be forced to play a violent game of catch-up. If gold reaches $5,000 and the ratio simply returns to its historical norm of 15 to 1, silver doesn't just hit $100, it clears $300 and accelerates toward our ultimate target of $500. This is a mathematical certainty if the world returns to a commodity-backed currency. We are witnessing the slow, painful death of the petrodollar and the birth of a system where physical possession is the only thing that matters. In the paper trap, investors were told that silver was just an industrial metal used for solar panels and electronics. While it is true that industrial demand is at an all-time high, silver is first and foremost money. When the public loses faith in the purchasing power of their currency, they don't run to copper or iron. They run to the only two metals that have served as money for 5,000 years. We have just seen the ratio break below a key support level of 60 to 1. This is the confirmation signal that the Great Reset is underway. The paper era, allowed for a massive divergence between the price and the value of these metals. But as we see in these charts, gravity is finally taking hold. The world is returning to real assets, and the ratio is heading back to where it belongs. We have laid out the evidence, and the conclusion is unavoidable. We are in the final leg of a massive structural three-drive bull move that has been decades in the making. What we are seeing in these charts is the ultimate reconciliation between the paper world of debt and the physical world of limited resources. The smartest money on earth, sovereign wealth funds and central banks, is already fighting over every single physical ounce and every available barrel of crude. Do not be distracted by the daily volatility you see in the paper markets. Those price swings are designed to shake you out of your positions before the real move happens. The institutions want your physical metal, and they want it at a discount. But, as we have seen, the structural deficits in both silver and oil are now terminal. There is no magic wand that can conjure 8 million barrels of oil per day or replace the 500 million ounce silver deficit that has accumulated over the last 3 years. Focus on the long-term breakouts. Focus on the fact that silver has spent 50 years building this base, and oil has spent 21 years preparing for the surge. In the world of high-level technical analysis, these are not just possibilities. They are the inevitable result of a system that has run out of road. We are currently in accumulation territory, the brief window of time before the vertical blow-off top phase begins. The window to position yourself is closing. As the physical shortages become headline news, the premiums on real assets will explode, making it nearly impossible for the average investor to enter the market. The time to understand these charts was yesterday. The time to act is now. We are moving toward a world where the only thing that matters is what you can touch, hold, and defend. Want more? Like, share, and hit subscribe for daily updates.